This is Macro Horizons, episode 377, A Season for Everything, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of June 8th. As the May data cycle unfolds, the inflation updates will present the next gauntlet for financial markets. Persistent risks, lingering unknowns, and so it goes. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. The week just passed offered plenty in terms of tradable incremental impulses, and as we look forward to the summer months, it's worth observing that we have seen the evolution of trading in the U.S. rates market weather some very interesting shifts and challenges over the course of the last year and a half. It's worth taking a step back to recall that following Liberation Day in April 2025, there were serious concerns about the potential for runaway inflation comparable to what we saw during 2022 and 2023. While ultimately this failed to materialize, and the most recent update of April's core goods inflation showed prices effectively flat, suggesting that the tariff risk is largely now behind us. The reality is that we now have a fresh reflationary impulse in the form of the energy shock. One of the key takeaways from the post-Liberation Day period was that the initial concerns that firms would be able to immediately and completely pass along tariff increases were exaggerated, and at the end of the day, suppliers, manufacturers, and distributors all absorbed at least some portion of the increase in costs, as did the end user. The final result was not a rebasing higher, at least not sustainably, of core goods and service prices, but rather, as the Fed had anticipated, a one-time price adjustment that was absorbed throughout the economy. Recall that 2025 was also a period in which the prospects for ever-increasing deficits translated through to higher term premium and the notion that nominal Treasury yields would rebase materially higher. This also ultimately failed to materialize, and perhaps more importantly, what we saw was that by the end of last year, we had returned to trading the classic U.S. fundamentals of growth and inflation expectations. So in this context, the response of the Treasury market to the developments in the Middle East and the energy shock is somewhat encouraging because it's a narrative about forward inflation expectations and the potential for pass-through. Now, while we don't share the market's current angst that this is going to truly recast the forward inflation complex materially higher for the foreseeable future, we do take a reasonable amount of solace in the fact that the Treasury market is, once again, relying on the fundamentals more so than concerns about Treasuries as an asset class or concerns about the dollar status as a reserve currency or concerns about global investors materially unloading treasuries and replacing reserve assets with other fixed income instruments. Well, to be fair, some diversification against U.S. treasuries into other fixed income assets, often also dollar denominated, such as mortgages and SSAs, undoubtedly has occurred. It hasn't been such an overwhelming force as to truly recast the market's forward expectations for the range in which nominal 10 and 30-year yields will reside for the foreseeable future.
Well, Ian, we've made it to June against all odds, and it's been quite the year so far in the Treasury market. The war in Iran has obviously dominated trading and the overall discourse in the market over the past 2 months, but it's worth taking a step back and evaluating the broader themes that we brought coming into this year and how what's ultimately played out has updated our thinking around the distribution of risks of where it is the market's going to be going over the next several quarters. Coming into this year, it was broadly expected that following December's rate cut, and given what was a growing concern about the state of the labor market, we would see some follow-on accommodation from the FOMC as the committee endeavored to bring rates back to what they thought was something a bit closer to neutral. Obviously, what's played out is a labor market that, thus far, has been far more resilient than was initially expected to be the case, and a firmer inflation backdrop that has obviously been further skewed to the upside, given what we've seen in terms of the second quarter's oil shock. And so it's little surprise that what was expected to be a year of more rate cuts has now shifted to what could certainly be a full 12 months with the Fed doing nothing. Other than what we expect will be an increased focus on shrinking the balance sheet, given that's one of Chair Warsh's highest priorities, and this in turn has left 10-year yields to trade at a range that's probably better defined by 4% to 4.75 instead of something closer to 3.50 or 4.25. In terms of the yield curve, the reaction follows with this logic, as 2025 steepening has given way to an impressive flattening reversal with 2-year yields now comfortably sitting just above 4%, and the broader global monetary policy rethink with the Bank of England and the ECB talking about hikes has now left a higher for longer interest rate outlook the path of least resistance going forward. What we're left to consider are the broader structural themes that are not going away, namely what AI means for labor productivity, how shifting demographics and immigration policy may be changing how investors interpret the labor market, and of course how long the resilient growth backdrop can persist.
And in keeping with the theme of a mid-year performance review,
you're doing great.
So are you. It's worth putting in context things that have not changed over the course of the last, let's call it 12 months. Recall that in the middle of last year, part of the macro narrative involved higher rates because tariff pass-through would occur on a 1-for-1 or 100% basis. Now, what we have seen over the course of the last 12 months is that there were pockets or moments in which core goods prices were higher, reflecting increased tariffs and levies, but that has been relatively well contained. And in fact, core goods prices in the month of April were effectively flat. So putting this in the context of the Fed's major concerns last year, we've moved beyond tariff pass-through risk. Now that has been replaced by energy shock pass-through risks, which, of course, as you point out, Ben, has left the Fed on hold for the foreseeable future. But it is worth observing that the prior wait-and-see position of the Fed ultimately did bear fruit insofar as the FOMC didn't need to tighten monetary policy. Another narrative that has passed from 2025 was this idea that treasuries would lose their status as a safe haven asset. Now, to be fair, there have been allocations away from treasuries as an asset class into other currencies or into other dollar fixed income assets, but by and large, the treasury market has remained largely unaffected by these shifts. Also recall that there was a concern that the runaway deficit in the U.S. would embolden investors seeking materially higher rates further out the curve. And as we have seen recently, there might be moments in which five-handle 30s become a reality, but that certainly doesn't appear to be the norm on a go-forward basis. Let us not forget that there were moments in which it appeared that the dollar might lose its status as a reserve currency. That certainly has not occurred, although, to be fair, its status in this regard has incrementally diminished, but there hasn't been a wholesale shift away from the U.S. dollar. As a result, what we find is that we're once again back with a very familiar dynamic in the U.S. rates market. 10 and 30-year yields continue to be driven predominantly by the global growth and inflation outlook, with a term premium added on that depending on where we are in the cycle, whereas the 2-year sector is primarily a function of monetary policy expectations over the near term. As a result, given our assumption that the Fed is unlikely to be in motion anytime soon, that means that the shape of the yield curve has effectively devolved in being nothing more than a directional trade. So we see moments in which there is bear steepening and bull flattening. Now, while we do not expect that this will always be the case, it certainly does seem to be the knee-jerk response in the market for the moment.
And then there were tariffs. The hallmark of Trump 2.0 has obviously been a renewed rethink of the U.S.'s trading relationships around the world and a shift away from multilateral trade agreements to deals negotiated far more on a bilateral basis, and an increased willingness to use tariffs and leverage the strength of the U.S. economy through a trading channel for the administration to achieve its geopolitical goals. There was a large concern that the increase in import taxes would flow through to higher inflation, fears that largely proved to be unfounded, and while there were certainly signs of some goods inflation resulting from tariffs, they hardly flowed through to the broader economy in a way that really drove a rethink of the inflation landscape in the U.S. Clearly, the Supreme Court's decision that the president doesn't have authority under IEEPA to unilaterally implement tariffs holds broader accounting questions for the deficit and how the funds raised from tariffs over the last 12 months will ultimately be repaid and how that deficit benefit is going to be made up. But it's clear that while tariffs may be detrimental for the global economy and the Trump administration's more freewheeling approach to negotiating trade deals with some of the U.S.'s biggest trading partners has increased uncertainty, tariffs did not ultimately prove to be the impetus for a significant move higher in inflation or massive consumption hit. And particularly as attention starts to turn toward the midterm elections in November and further potential political changes in Congress, trade policy, the use of tariffs, and collective thoughts around the deficit will certainly be relevant for congressional elections and in determining which parties emerge with control of what chambers.
One of our concerns when it comes to the midterm election is less that we're going to see a landslide in either direction. It is very much open for debate. We think the safe assumption is at least one chamber flips. And as a result, it will become incrementally more difficult for initiatives to get pushed through. The unique aspect of the last 2 years of Trump's second term will come in the form of how he chooses to either accelerate the use of the powers of the executive branch or, as is typically the case, transition into legacy mode, where the president would focus on rounding out some policy initiatives and setting the stage for the transition of power. Our concern is that we could see this administration become more ambitious on the geopolitical front, particularly in the Western Hemisphere, which of course would raise more questions than it would answer. So as we consider the event risks surrounding the midterm elections, it's difficult to disentangle that from what the results might imply for the last 2 years of Trump as president.
And this reinforces an observation we made in the early days after the U.S.'s capture of Nicolas Maduro earlier this year, and that is that the shift in politics that, quite frankly, began in 2016 has made the world a far more separated place and agreements much more bilateral than was previously the case. And so at the end of the day, what a greater level of geopolitical uncertainty and a potentially more kinetic international landscape ultimately means is that the cost of doing business, even excluding tariffs, is going to go up. Cross-border transactions that were once very easy have become marginally more difficult. There are new variables that businesses need to consider before making CapEx decisions, and all of this means that the baseline costs running in the global economy have shifted higher. What this ultimately means for interest rates is not necessarily that 10-year yields are bound and determined to touch 6%, but rather that it's extremely unlikely that we're going to return to a sub 1% or frankly even sub 2 or 3% 10-year yield environment that dominated the post-financial crisis period and obviously into COVID. So it might be higher for longer, but that doesn't necessarily mean it's much higher than here.
So what you're saying, if rates can't get much higher, they're probably going lower, right?
Or sideways. That's always an option too.
In the week ahead, the Treasury market will once again have the updates on the inflation front from which to derive trading direction. We know that headline inflation is going to continue to be biased higher, and the wild card really comes in the form of whether or not there's significant pass-through to the core inflation series. Recall that a lot of the post-pandemic period was spent seeing stickiness in the housing sector inflation components. OER and rent were consistently erring on the upside simply because of the lagged flow-through of elevated home prices into the inflation series itself. This created a pillar of inflation that made it very difficult for the Fed to bring core inflation back in line with its objective. As a result, the Fed chose to refocus the market narrative toward the supercore measure of inflation. Supercore inflation being defined as core CPI services excluding OER and rent. Now, this level was elevated early in 2026, adding to lingering concerns that we were going to see an episode comparable to the beginning of 2024 as well as the beginning of 2025. However, there is a fair amount of seasonality in the inflation complex, and so investors as a theme were not surprised to see that initial upside. There was also the process of continuing to recalibrate the primary inflation series following the government shutdown that resulted in effectively no data for the month of October. And what we saw in the April CPI print was that as the BLS sought to effectively backfill some of the missing data, that there was some upside in OER and rent. However, we'll caution that that was in keeping with expectations and therefore shouldn't be particularly surprising for investors. As we think about the May inflation complex within the core CPI series, we will not only be watching for the OER and rent component, but also core goods. Recall that in April, core goods prices, which is the area in which one would expect tariff pass-through to be the most relevant, was effectively flat. So from the Fed's perspective, this was a good development because it implied that the shift in the U.S. tariff regime did translate through to idiosyncratic one-time price adjustments as opposed to becoming embedded in households' forward expectations for inflation. Now, obviously, the energy shock is going to once again bring into question how stable inflation expectations are going to be on the household level, which is why the market continues to respond as it has to fluctuations in the energy sector. Let us not forget the week ahead also contains PPI, which will help level set expectations for the input prices and any potential pass-through from producers onto consumers. While this obviously does occur with a lag, and it certainly isn't a one-for-one pass-through, it will still remain relevant over the summer months and a touchstone for those anticipating a reacceleration of inflation. Treasury investors will also be tasked with underwriting 3 key auctions. We have Tuesday's 3-year of $58 billion, followed by the 10-year at $39 billion on Wednesday afternoon, and this will be capped by the $22 billion 30-year on Thursday afternoon. As a theme, auctions have gone reasonably well, given the amount of volatility that there is in the macro outlook, and we do not expect that to shift anytime soon. The upcoming data calendar ends with the University of Michigan's June print. And this will give us an updated look at inflation expectations, particularly the 5 to 10-year sector, which has been biased higher since the beginning of the war. This will be a key measure for monetary policymakers as it provides one of the longer data sets for survey-based measures of inflation. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. In the spirit of taking a longer-term perspective, we're reminded that one must remember this: a miss is just a miss, a sigh is just a sigh, and the macroeconomic fundamental things apply as time goes by. You're welcome for not singing that. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.